Hey folks, Nick Shaheen here looking at cannabis. I haven't done that in a while, I don't think. It used to be a weekly thing. So let's revisit the cannabis. I will start with CGC because that's my thing. I start there and I think I'm going to do Tilray, maybe ACB or an MJ. But if you look at them, they're all the same. They all have a battle going, and most importantly, that it's happening at a very important period, spot as far as price. And let me explain to you. So we're looking at a daily chart for CGC, so about a year's worth of data. Um, this is what most people look at, the daily chart. So you notice that there's a descending lower high trend. You can draw a line this way, and you can draw a line that's slightly ascending that way. So we have a battle going between sellers and buyers, and the range is going from this wide and pinpoint. So here's the earth-shattering statement. It can go up or it can go down. What? Yeah. So something is going to happen in the next few weeks, and there's going to be a burst. I can't tell you which way, but I can tell you what are the levels to watch for and how to handle them for me. So first, I can look at the battle where it is right now. This orange line I didn't draw. It's an automatically drawn line. It's where literally there's been the most action. So unfortunately, it's above current price. That's a problem because that is congestion. Anytime they come to this point, both sides love it, so they're going to be trading it fast. Both buy, sell, buy, sell, buy, sell. Volume, look, by a lot. So there, it's going to be resistance. So now the bogey on top, if somebody's optimistic, they're buying the dip right here from last week. I don't know why it dropped, but it did. And if they are buying the dip, it's viable. I understand it. They're falling into support. Then I would stop out here or here. So that's the strategy on the bottom. If I'm long, I would stop out here and here, not because the company is in shambles, because technically it will find sellers below here. Where? 20 to 16. What? Yeah. 20 is a buyable dip. I'll show you why when you zoom out to like a monthly chart. You'll see that 20 and below is a buyable base. But some things are going wrong. What happened to the nationalization, legalization on the national level conversation? I don't hear much about it, but maybe it gets rekindled. So the companies are still doing this well with the fact that they're still illegal in the US, which is crazy. So kudos to the management teams to be able to do all of this and gain legitimacy on Wall Street when they're illegal to basically take their money from state one to state two. It's very strange setup. So kudos to those teams. So that's the if somebody bought the dip, they should stop out from a technical perspective. And I wouldn't add if it falls to 17 or 18, because we don't know where the bottom is. So if I'm long at 20 or 21, I wouldn't add at 18. I would add at 14. You're saying it's never going to 14. You say never. I say if it goes to 14, that's where I would add if I'm long already in the loss this. I wouldn't add anywhere here because we don't know. Technically, this peak makes the risk of the low being we can't even talk about it. But let's assume only half of it matters. Then it's well doable to be down here. But you're thinking in a vacuum, like this stock will never go there. This stock will never go there on its own. But if the stock market corrects 20%, it will definitely go there because it's not trading in a vacuum. You're saying market 20%? Yeah, let me show you what that looks like. First of all, that's the 28 level I wanted to show you that is pivotal right here. And it plays a role. But anyway, let's go to the SPY. Let's go to a quarterly chart. Does this look like it cannot correct 20%? So 20% is here. How crazy is that? It's not that crazy. Okay, so yeah, everything has to trade in the prism of the entire market. So nothing trades in the vacuum. So itself, all alone, should have a lot of support, 20 to 16 to 18. I would be confident catching the falling knife if the markets are still somewhat as bullish as they are. The Fed's playing a game of fire here. and some things can happen. Anyway, on the upside, a breach of these failures, because look, fail, shorter term, could bring a burst higher. Now, it will have a lot of resistance from 28 plus or minus, from 30 plus or minus, from 34. Every level is going to be a lot of sellers lurking. So the triggers are, if somebody bought the dip, to swing it back up, trim some and ride it if they can, or stop out. If somebody hasn't bought the dip yet, they can do that with a tight stop. If somebody doesn't want to do that, they can wait for the breach of this and chase the breakout. Many ways to do it. Buy the dip or buy the rip is doable. So basically ping pong until one side breaches and then chase it in that direction. That would be my statement. And look, it's the same thing for Tilray. Similar situation. Tight range, important volume profile, look left, has support. I like this one better actually than the other one for some reason. Cleaner chart, better ascending, higher lows, and I guess you can do MJ, but they look the same. So I definitely wouldn't do three of them. I would pick one or two. One of the three to trade. It's like they look the same. Why concentrate on one? Better than to just try to trade three, and then I have three trades to manage. All right, so as far as fundamentals, cheap or not cheap, doesn't really matter. They're a lot cheaper now. When they first burst onto the scene, their valuation was insane, as in price to sales. They had like a few hundreds, a couple millions of sales or whatever, and it was like market capitalization that was insanity. So let me show you something. The OG of super spikes, Tilray. Let's go to a monthly chart. It spiked to $300 in a matter of days. I tried to trade it on the way up. I sold puts on a Friday around 40. It was up over 120. I couldn't even buy them back to book my profits. That's how volatile it was. So it has done that a couple of times. So if anyone is thinking of shorting companies like this, make sure I would make sure I would use the options to short. How? Because I can deploy finite risk. So if I wanted to quote short, bet bearish on a stock, I would buy a put or a put spread. Maximum money I spend up front for that trade is the maximum amount of money I can lose. Or sell a call spread, not calls naked. I would never be short a stock in this market, let alone these guys. The idea of selling short, I don't know if you know this, but to quote sell short a stock, I borrow 100 shares, I sell them, I put the money in my bank. If I'm right, the stock falls, I return 100 shares, I only have to buy them at lower prices, and then I'll keep the difference. However, if it super spikes, then I'm losing money for as long as it's rallying. Not a good situation to be in. Selling a call naked, same thing. I'm in trouble for as long as the price is above my call and rising. So selling a call spread, I've done it. I did it in AMC a couple of weeks ago and I won at 60. It was a Friday deal. I sold into it on Thursday or Wednesday, and I said, if it's not, my bet was it wasn't going to go close above 60, and it didn't. So, but my maximum loss was set. I risked 30 cents to make 20 cents per contract. So that was my finite way of picking a fight with a super spiker and not risk the financial well-being of my family. I don't want to view it, no. So the scenarios are similar. Tightening ranges, good support below, tradable tops, but I would chase the breach of the top or the bottom in that direction. If I'm long, I don't immediately double down. I would wait for the big drop to double down, not just Tilray, all of them. They trade almost the same, which is the good thing about this. They're somewhat predictable that way. All right, Nick signing out here.